This short clip is from my live trading room. You can engage directly with my fabulous team and me at LaDucTrading.com for all our research and trades. Or for just my daily live streams, you can access via YouTube memberships. All links are in the description. Remember how yesterday we were talking about my call the past little bit, which is basically once we got up to this 71.91, if you recall, which is right about this purple line. It was right above here. I said, okay, so 71.90 or 91 is the 127 fib extension of this pullback from February into last of March. That extension, if we get and stay above it, if you recall, we came down just a little bit and then we popped above it. And then I said, I do expect a little shake and bake at this 72.73 neck of the woods. And I said, but I expect it to get defended at 71.91. And we did, on way up to the 161 fib retracement level of 74.25-ish. It's not a game of perfect. Well, yesterday we hit a high of 74.29. Now, does that mean we're going to do a hard pullback? No, but I did say it does typically digest here. Under usual circumstances, we could expect some shake and bake back down into this gap fill from right here, Tuesday, May 5th, and we're May 12th. All I was expecting was a pullback into 72.73.26, remember? And Michael said max pain strike is whatever, 734. Okay, so that was for SPY. And we have a little gap down, ta-da, at that 74.25 SPX target. Now, is this going to turn into an 18 to 20% pullback, which is what I posted has high potential, and I posted that at least a month ago because it's a seasonality chart thing. It's a midterm election thing. Remember that? So I know Yardini is coming out with 8250 by this year, raised from 7700, and we have a whole bunch of hot fire flames, earnings increasing, earnings reports and expectations moving higher. We've got CAPEX, build out, supply constraints, sold out memory as far as the eye can see. We've got China-US trade meeting Thursday and Friday. Everyone's very excited. But we also have that mid-cycle, midterm election pullback that has happened in the last 17 cycles that equaled 18 to 20%. Before it went higher, by the way. But first, we got to pull back before we have the energy to move higher. All right, so the point is, look for that starting now. Now, if we have a continuation of some weakness, let's see how far we can actually take this, but it does align, which is so funny. You remember all these years I've been saying we have a May 12th birthday rally, which is usually you see this bump up in mid-May. It is May 12th and we have a bump down because it's a midterm election year, because oil is very hot and sticky, because yields are moving higher this morning with dollar, and it's a headwind to equities. So I would say start planning for that unless we can get back and stay above this 74.25 in this 6 weeks or 6 weeks of green on your scene doesn't obviously turn into something a little bit parabolic. We've already pushed very far from the mean. I'm talking about the S&P 500. The mean is more in that 7,000 neck of the woods. So the reversion of the mean would take place as we come incrementally through each one of these moving averages right back into that kind of 10-week EMA at about 7,000. We'll see. Level by level, let's not get too ahead of ourselves. But I did want to highlight that. And we've got some inflationary impacts that are starting to potentially weigh on markets as they look forward. We have a new Fed chair that is really stuck and doesn't have consensus to cut anyway. And we have an Iran escalation that absolutely is still in the house and not resolved with rising oil prices. So that's it. I just want to highlight the fact that we had already seen VIX on the scene, oil up, markets up with VIX up. Now we've got yields and dollar up. That's the recipe for, okay, let's just protect some of these hard-earned gains. And you can see that that is what I'm still expecting, like a little bit of a pullback into that 70, 72, 73 gap fill from May 5th. And then let's see if it has more to push short. You'll get an opportunity. You'll probably also see a lot of puts coming in around the 7,000 to 7,200 range. Some of you are not into advanced options, but I did discuss with an edge client yesterday the concept yesterday when we were right up here of literally in SPY selling an at the money put of 740 and then buying a put spread or two out of the money puts like the 725 or 715. Basically, the two out of the money puts because they're expensive, relatively speaking, right now, because VIX is moving higher with the markets. Remember that? So anyway, this is one way that you could play a push that is coming back in, but there are lots of plays. Anyway, one at the money put sold and buying two out of the money puts. Just an idea. It's just the beginning here. Let's see if we can get a little bit of 72, 73 coming in, and just keep in mind that this is definitely could pick up speed. But for right now, I think people are going to start to get some creative put structures in play because the higher volatility has really made this a little more expensive than usual. So Charlie McElligott of Nomura, who you know is a quant and I follow closely, highlighted index options skew at 0 percentile. Can it go below 0? No, it can't. Can it stay there? Yes, it can. Put skew is at 0 percentile, call skew is at 100 percentile. This is screaming outliers revert with velocity. So just keep this in mind that we are at some very, very extended levels as it relates to this call mania. Everyone's more positioned for 1999, by the way, than a mid-cycle election year pullback. So let's just remember that. Market is way, way bullish. Right now, this little reminder that stagflation and supply risk with supply chain input costs rising hasn't even been priced in. Rate cuts priced out. None of that matters because they still have forward earnings expectations for semis and AI related stocks moving aggressively higher, and tons and tons and tons of AI capex build out and all the ancillary effect. So every dip, until they have a real reason not to buy the dip, this market is still pricing in 1999, not a mid-cycle election year with potential 20% pullback. Nope. That, you know how I know that? This kind of stuff. That's why. You don't get a put skew at 0 percentile and call skew at 100 percentile unless they're pricing in 1999. I can say that with confidence. That's why. So your small cap short is productive, but those are the levels. Hopefully that helps. And then I would say 276 is the 21, 278 is the gap fill, 276 is the 21-day EMA for small caps. And the mean is way the heck down here in the 270 area. So level by level, let's just deal with this first. The fact that it's on support and the fact that we still have a few more points before we do a gap fill and likely a little bounce before 276. And then let's see what happens then. Cues aren't falling apart. We're on right here. Support level 3 on the intraday. We just broke the 3-day EMA. We've got a gap fill at 695.55, but not today. That would be surprising, but that is the gap fill. And by the way, we also have a gap down on the hourly, but not the daily. There's still, remember, this market is pricing in 1999. So to have a little case of vertigo shouldn't be a surprise. And when did it happen? Ironically, on CPI day, when SPX had just tagged 74.25, my fib extension level, and we're down 0.7% in SPX, but I see 73.41.39.
Join Club to trade with Samantha. Scan this QR code or click the link in the description.